Hey guys and girls, welcome to this week's Tuesday Night Live. Lots of things to talk about today, and we shall get into it. So, just trying to get my camera all set up. All right, here. Should have done that beforehand. It changes when we go live, but here we are. Just wait for a few of you guys to hop online, and we'll get into tonight's Facebook Live. People have been asking me, what do I think is going to happen with interest rates today? Interest rates are not happening today. They will be happening next week. And if they do make a change, I will do a special live, because I do these lives every fortnight. I'll do a live next week. So thanks, Colin. Glad to hear that you can hear me. Sam says here, puts up a little message, so I'll start reading the comments as people start hopping online. Maybe people are out there trick-or-treating. I was just driving to the office and I was like, seeing all these people walk through the streets and knocking on doors begging for food. It sounds like the apocalypse that we're going through every day. But Sam says here, US debt now at $33.684 trillion. Consumers starting to feel the pinch, and credit card balance are at an all-time high. The savings at an all-time low. Surely the reversal will happen soon, although rates will probably go higher first, but the higher they go, now the better. The more aggressive the reversal will be on the other side, and bigger for the fan. The bigger the fan stimulus money will be. Exactly. So, the more damage that they're causing at the moment, the more the bigger the problem, the bigger the treatment will be. So, yeah. Someone said here, Matt said, no podcast this week. Yes, there was no podcast last week. There should be from this week moving forward. Obviously, I've been traveling a lot. I've been all different places doing so many different things. And we were short of a podcast for last week. So apologies for that. I'll make it up to everyone one way, shape, or form. On that note, I might talk. Today's topic is tips on how to build a large property portfolio. I might share my journey of the last week, what I've been doing with some of my properties, some of the things that I've been looking at out there, and just having a bit of a trip down memory lane. But before I get into that, we have our news articles, and boy, do I have some doozies for us this week. So let's get straight into it. And people keep asking me what's my thoughts on the interest rates. They could go up, they may come down, they may do nothing, right? My thought is on interest rates. We'll get into that in a moment. So this one here is an article here, rapid rate of rental disaster engulfing Australia, right? And you can all picture, an ABC article with some, females with no fringes, hairy armpits, and purple hair, and those sorts of things, going, how dare these guys, they're pushing up our rents, they should all go to jail for supplying us with a rental property, right, without looking at what's underneath it. But let's go into this article. This doesn't seem like that, but let's go into it. Australia's rental market has turned diabolical. The latest rental data from PropTrack shows the nation's vacancy rate has plummeted to an all-time low of 1.06%, with every market across Australia experiencing extreme tightnesses. There's lots of stats and whatnot here. Every time you go into the news, apart from seeing new countries getting invaded, or another company has died suddenly, or someone's died suddenly, or whatever, you quite often see these articles now about how bad it is for the rental market. And this is caused from inflation. We had inflation of debt because they've blown that debt out to be tens of trillions of dollars, which has now flowed on to inflation engulfing everyday families out there, and inflation starting to turn into hyperinflation. So the exciting part will be on the flip side of this. If people think they've got a rental issue in their property, just wait until you see that you can't afford food and all that sort of stuff, which is happening out there. It is happening, folks. I took great pride in seeing this article. Tremendous pride in this article, right? And I will get onto it. And there's a word in here which some of you would remember me talking about 2 years ago. I said I don't have any exposure to paper assets, I don't own any shares, and these companies in the stock markets are all a big fat Ponzi scheme. And that's why, I see a lot of people jumping out of their super funds and putting their money into physical assets because the day that the stock market starts collapsing and goes down by 20% or 30%, just take a look at the charts. Go look at the ASX, the Dow Jones, whatever, from February 2020 and March 2020, and you'll see that it just dropped like about 40% over a period of a week. That is not too uncommon from a normal type of recession or depression that we would enter into. I said at the time that there would be these companies that would come and haunt everybody, right? And it's very fitting that I have this, and it is Halloween, because I don't buy into any of this consumeristic stuff or a satanic day that they're trying to shove down people's throats, right? But anyway, 127 ASX listed zombie companies on the brink of collapse, KPMG research warns. So, what is a zombie company, right? Everyone thinks the economy is made up of these great companies, household names, whatever. One of the articles I've got is about Sara Lee, right? The cheesecake company. So I'll just show you this, right? Sara Lee, if you haven't seen it on the news, Sara Lee goes into administration, right? We will get onto that in a moment. All these companies that people think they're like supplying jobs out there and all this sort of stuff, they're all funded via, different types of capital raising, debt instruments, how they've leveraged them and raped and pillaged companies. I was looking at one recently. I'm not going to go into details of it. I've had a goal of taking a company off the stock market for a very long time, and I looked through all the numbers of it and all the financials and all that, and I was like, hang on a second, right? This is all a big Ponzi scheme, the business. I could see through all the cracks and how these backhanded deals and form. So I look at these companies and I think to myself, like, what companies out there are real, right? You've got tech companies that just keep losing hand over fist. Amazon's never made money. Tesla's never made money, but they've got supporting and funding from places that are, very mysterious and dark that are out there. And, if they just turn off the tap or there's no liquidity flowing into those businesses, they don't have money to pay for payroll next week or whatever the case may be, and they go broke. So here is 127 ASX listed companies. We'll go into the article and read them, because a zombie company is a company that appears that it's trading solvent, but deep underneath it's only built up due to cheap credit, lots of capital floating around the system. And the day that the credit drives up and the capital's not floating around for them to get the next round of funding and water that company down further and further and further, then they suddenly blow up and go broke. So let's read it. Dozens of ASX listed companies are on the brink of collapse and in need of drastic change to turn things around, with potential investors warned to be on the lookout for zombie firms. According to data from the Big Four accounting firm KPMG released on Monday, there has been a disconcerting rise in zombie companies in the wake of the economic downturn rocking Australia. A zombie company is defined as a company that generates just enough cash to pay for running costs and interest on their debts, but not much else, making them tether on the edge of financial ruin. And all it means is that if their interest rates go up and their costs go up and their bonds go up or whatever, then they can't afford to remain solvent and something happens to them, right? KPMG ranks all ASX listed companies out of 100 based on their publicly available results, and zombies typically score a 0 for 9 months in a row due to poor financial health. In the past 6 months alone, the number of publicly listed companies entering in the zombie zone has increased by 51%. There are now 120 zombies littered throughout the Australian Securities Exchange, up from just 84 in the previous like period. KPMG, head of turnaround and restructuring services, said zombie businesses were on the rise as the cost of living crisis continues to wreak havoc. There is a growing trend of them, Mrs. Dickinson says. There are more companies falling into this bucket. The average market cap of a zombie company, which is the number of shares multiplied by their price, has increased from $20 million to $24 million, meaning bigger companies are facing financial woes. Zombie companies currently have a total market cap of more than $3 billion, up by 82% in May. There are some red flags to look out for when investing to ensure you're not pouring your money into a zombie firm. Imminent breaching of loan covenants, having to manage supplier payments to sustain cash flow, significant tax arrears, or having a large portion of debt maturing soon, while underperforming are telltale signs that companies are perpetually struggling. According to the insolvency expert, a number of distressed companies in the Australian Stock Exchange are particularly concentrated around the natural resources and tech sector, right? Good old tech sector, right? Companies classified in the raw materials and natural resource industry saw an increase of 24 zombie companies, while technology and communications had 6 companies turn into zombies. And for the natural resources sector, he said massive geopolitical events such as the USSR area over there, and the recent conflict in the Strip. I could say a lot of things, but we're going to keep our mouths shut and we're going to keep going through the article, had caused key materials, including petrol, to become more expensive and had a major impact on supply chains. Meanwhile, companies in the technology sector are struggling because of outside funding is becoming harder to find. Who would have thought that that would have happened, right? A phenomenon known as a tech wreck. Surprisingly, the construction sector wasn't named and changed for KPM's new data, even though it's one of the industries driving insolvency rates across the country. Said it's because building companies haven't been hit as hard on the ASX, and most of them are smaller companies that aren't in the stock market. It wasn't all bad news, though. Unlike the global financial crisis, she explained there were other options available with floundering companies such as credit providers outside the big banks. KPMG's research comes as 20 ASX listed companies have gone under in the last year, a massive jump up from the previous period where only 8 had to call in external administrators. So it's gone up by about 140% to go to that. The most recent ASX corporate failure was Halo Food, which collapsed in August, going to both administration and receivership despite generating $59 million in revenue. Some other big names have gone under in the past 12 months, including the financial tech and buy now, pay later firm OpenPay, which shocked Australia and the rest of the world with the news of its collapse. There was also Hills Limited, which originally manufactured the Hills Hoist clothesline before selling the brand in 2017. Didn't know that Hills Hoist went under, that's a bit sad. An Aussie icon, Happy Valley Nutrition, and infant formula. Anyway. In August, News.com reported that 70% of all ASX companies were at the risk of collapse. So let's just think about that for a second. Why does Nathan sit here so happy, the world burning and crumbling and whatnot? It's because I'm not exposed to certain things and that I am exposed to certain things. I've got my cash flow in order. I've got my position in order. Inflation is serving me very well. For some other people, inflation is serving them very poorly. So you need to understand the risk that's associated, not just in a good market, but in a bad market, and for your position to be sustainable to move forward and be fluid and liquid to go in and out of different markets. So I've always, I guess, fitting into building a multi-digit portfolio. I was talking to one of my mates yesterday who's a builder. We went for a drive, showed him a couple of properties, caught up, and then he's like, oh, these things don't work. How much did you pay for these? Probably didn't know about my property portfolio. I was like, this one here, 200 grand. This one here, 140 grand. I used to buy land in Western Sydney for 60 grand, right? He's like, shit, right? And I'm like, the cash flow is amazing, but it doesn't work there today. And he's, I think, up to about 15 properties in the last year. And those properties are, they're in the same sort of price category, but they're just not located in the specific markets that I was buying it beforehand. And those properties have performed very well throughout any sort of financial crisis that occur out there. Sarah Lee, right? Sarah Lee, go and dig your mouse into the nice cheesecake, whatever chemicals they put inside their food. But pretty sad. Iconic frozen desserts company Sarah Lee has collapsed into administration, putting 200 jobs at risk. The Australian firm, famous for frozen treats including apple pies, cheesecakes and ice cream, has been a family favourite for more than 50 years. Vaughan Strawbridge, a couple of names there from a consulting being appointed as administrators. Australian Sara Lee business has a long history of producing desserts, including frozen cheesecakes, pies, crumbles, yada yada. You know what they do. The appointment of the company is intended to seek a restructuring and a sale of the Sara Lee business while continuing operations. Will be great interest for various firms in taking over the company, which once had a TV star, Sophie Monk, as its ambassador. We're working with Sara Lee's management team and staff to continue operations while we secure the future of the business. We're immediately commencing process to sell or restructure the business and continue its long history of manufacturing in Australia. We expect lots of interest in the business and will work with those parties and stakeholders to achieve an outcome, blah, blah. The company employs about 200 people. Pretty sad, eh? But that's just what's happening, right? That is just happening. That is just a sign. It's just a glitch, right? There's so many of these things. Hills Hoist. How many Aussie icons are going to collapse, right? Reality is that Sara Lee will probably stick around. They'll probably find a buyer. They'll chop it up. They'll put it incorporated in some other business. You'll suddenly... It's like when you go and get a paddle pop or a Bubble O Bill or whatever, it's just a big pole of goop that they put into the paddle pop. It's very different than what you used to get. They will probably just make cheesecakes and apple pies and put them into some other brand, keep the name, and someone will pay a couple of $1 million, take a bit of the infrastructure, pull the eyes out of it, keep the brand. People think they're still buying a Sara Lee cheesecake, and things will just get worse in their lives. So it happens constantly, right? But in times like now, it's happening more and more and more, and I expect that it will happen more and more. And I am excited that it will happen more and more because from my portfolio, I thrive in times like in the GFC. I quit my job. In Corona, I doubled my net worth. I didn't have to do anything, right? And it was just due to the assets that I was able to secure and the structuring and the planning and all that sort of stuff behind it. So what is going to help out with our property portfolio? So let's just check out this article here. Australia's bold population forecast has grim home truth information informed decision. Australia has been tipped off for a 7.4 million person population boom that will need another 2 million homes built by 2041, another 2 million homes. That's only like 15 years away, right? 2041. We need 2 million homes. I don't know how many homes are in the country. Maybe someone will share it in the comments box and go and do a little quick Google check and see how many homes there are in the country. But we've only got like 25 million people. We're adding 7.4, so that to me shows that we've got about a 20% increase of people, meaning that would need about a 20% increase in housing for them. But the figures produced by a demographic group would have Australia still facing, I'm just reading through it here, firms' authoritative data is used by more than 100 councils around Australia and is being released publicly for the first time. Investors struggle to find properties. It adds a further weight to the suggestions that a 1.2 million unit homes target by the end of 2029 would improve the situation. It is unlikely that we're projecting we will have a big impact on prices. If you can increase the supply of new homes, you will impact prices. We have to build the infrastructure to create dwelling construction opportunities, and that will need investment. So when I go to buy a property, and I buy it for 200,000, let's say, if the area had not enough properties in it, and then developers found the opportunity to come and build a property and put it in the market, they wouldn't be selling properties for $200,000. It would cost them 100 grand for the unit site that would sit underneath it if they were lucky, maybe 200 grand for a block of land, 300 grand for a block of land, and then it'll cost for the construction, which could be $200,000, $300,000, $400,000, $500,000. You're probably looking at a minimum of $500,000 to buy a basic 2-bedroom unit today, brand new off the plan from somewhere, if you were able to do so. So naturally, you have the vortex where all the existing stock gets sucked up into that market. And that's the exciting part about it, because inflation is impacting the prices of build costs get sucked up, migration is increasing because they need more migrants to pay the debts that the nation has got. So the bigger the mess, you've got to look at what will happen, right? If you are driving down the freeway and you're doing 50 k's an hour and you turn the car, well, it could go off in this trajectory. But if you're driving at 200 k's an hour and you hit a little rock on the road and your car goes, ooh, right, you're going to be straight off and you're going to be flying backwards. So you need to calculate those things as the policymakers. We're not controlling the policy, but we have access to the chessboard to be playing on this game. So it's pretty exciting and important to do your research and understand that. This one here, for some reason, I don't have the full article. I'm going to get this and put it up. Where are we? RBA 43. I should have checked this beforehand. 43 billion losses. AFR. Here we go. I've got the article that I had from the other day. It's already saved there. Put it in my 12-foot ladder. The 12-foot IO doesn't work at the moment, so maybe we'll take it off that server and put it in a different server. That's strange. I can read it. This is the article here. This is exciting. $43 billion in losses put pressure on Chalmers for a bailout. Are we going to see a bailout occur? Are we going to see the interest rates go up? People are asking me about that. So if we've got the government in debt, right, there's $43 billion in losses. There's going to be people, corporations, banks, commitments that don't go through, and the government, the central bank, will have to make a decision, and whoever owns the bonds, do we blow up? Is the company better alive or is it better dead? Someone can shoot the company in the head and send it off to the graveyard, but then no one gets paid. So do you want to crystallize the loss to your balance sheet? No one wants to do that. So they're scared of blowing up entities. So what they have to do is they have to accept that they're not getting the revenue that they want. It'll have a flow-on effect. And here we are looking at the RBA at the moment, the central bank in the country, and it has massive losses. So looking at what they can do to fix it and what actions that are happening and what that will have as a flow-on effect. So if we see interest rates go up next week, we've got interest rates of 410 basis points, which is 4.1%. Interest rates were 0.1% going back a year and a half ago. So technically, interest rates have gone up 4,000% in the last, or 40 times higher. So the government's debt of $1 trillion at 10 basis points was $1 billion per year. A very humble figure of interest, right? The government could afford to spend $1 billion a year on interest. But because the bond has gone up, when those debts roll over, as those debts start rolling over, the government has to go and refinance that debt, which is 400 basis points higher. So that $1 trillion worth of debt that our government has taken out then turns into $1 billion a year, now is $41 billion a year worth of extra revenue that the government has to come up with. Where do they come up with that? They have to tax, they have to create new Ponzi schemes there, and So let's read this article. The Reserve Bank of Australia has huge financial losses from its extraordinary pandemic stimulus measures, have blown out to about $43 billion and sunk its balance sheet deeper into the negative equity. The steep losses, that's a very important word, right? The government has declared that they have negative equity, which is crazy. The steep losses have led to calls from economists for Treasurer Jim Chalmers to inject up to $30 billion of emergency capital into the bank. So they're asking Jim Chalmers, the Treasurer of the country, to inject $30 billion into the central bank to try and keep it afloat. While others have urged Big Four banks to be forced to repay some of their windfall gains earned from their RBA losses. Rising interest rates that the RBA pays commercial banks and a plunge in the value of the RBA's government bond portfolio. So what everyone's got to realise is that the more that the interest rates go up, the lower that the bonds are worth, right? And this is what caused all the banks to start folding early in 2023, is because the bonds are losing their value, right? So the value of the money in the bank is not worth what it was because people are wanting to. It's very exciting what is happening out there, because the more that they push the interest rate up, should they do that anymore, the damage has already been caked in. It's just, when is someone going to blow up? When is something significant? We're seeing all the key attributes there which occurred to the GFC. And some of you might be sitting here watching this saying, "Oh, I'm watching Birchie talking about property investing. Why is he so excited by property? Why is he so excited?" Because we have an opportunity right now to take assets before they get inflated away. Every time that there's a collapse or a catastrophe in the paper markets, property price, interest rates have gone up. Property prices have still gone up with interest rates rising. So imagine what will happen to property prices when interest rates come crashing down and we've got inflation everywhere and people can service for more money, debt and liquidity keeps flowing around through the system. That's going to be, kaboom, right? So the bigger the problem is, the bigger the solution will have to be to fix that problem. The bigger the solution is, the more inflation that's going to come our way. So I believe we've got one more cycle before the whole thing pops. Well, this is the last cycle. Rising interest rates that the RBA pays commercial banks and plunge in the value of the RBA's government bond portfolio caused the central bank on Thursday to reveal its annual report for an accounting loss of $6 billion for the last financial year, compounding a $36.7 billion loss in 2021-2022. So that's not saying that you had a $6 billion loss this year, you had $36.7 billion loss that year. Those losses are being stacked on top of each other, right? So you're getting further and further in the hole. That's the central bank here. Now, the bank's balance sheet slumped deeper into the red to a negative equity position of about $17.7 billion in 2022 to 2023, meaning that the value of its liabilities exceeded the value of its assets. Just think about that, right? They are very, 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 very bad. So if we have a look here, how can I share this? So that's the value of their assets, right? So if you have a net worth, the central bank's net worth, the red, that's gone into negative. It's negative equity. If your property portfolio was worth $1 million and you have a debt on it for $1 million, it's neutral. If your property portfolio is worth $1.5 million and you owe $1 million, we've got $500,000 worth of equity there. If your property portfolio is worth $500,000 and you have $1 million worth of debt, you're negative in the hole for $500,000. So we can see here where the profits generally are, which is the blue and the yellow, but now we're in the blue and the red on the other side of it, right? So that is very exciting because it shows not just the normal banks are in trouble, the central banks are in trouble, governments in trouble, global governments are in trouble, and they have to do something to fix this, right? So how do they fix it? They go, well, let's just, imagine you've got an insolvent business, one of these insolvent businesses, they should be taken on debt and run a reckless and, strip out the company and hand it over as a bit of junk, right? So with our currency, what they're just doing is that they're just printing this currency and printing it into overdrive and printing their way through it and going all the way over it. So, yeah. So looking at it, a commercial bank or a business in negative equity would be bankrupt, right? That's literally what the article is. It's on the AFR. This is the article. If you're beyond the payroll, you can go and read the whole article. But a government-backed central bank that can print money cannot be insolvent because they just keep printing this money. The RBA projects that the negative equity position will widen up to $27 billion by 2025, and that it won't return to positive capital until the 2030s, under 4 future interest rate scenarios. This does not affect the bank's operations or its abilities to perform its policy functions, former Governor Philip Lowe said in 2023 report signed on September the 6th. Nonetheless, the board will seek to restore the bank's capital over time through the retention of future profits rather than paying these dividends to the government. The Treasurer, Jim Chalmers, has indicated this continued support approach, noting that the decision about retention of earnings is made each year. It goes on to say what the old boss got paid at the RBA. The central bank is a lender of last resort to the banks, and people need to have confidence he can step in when a crisis occurs. Say the Middle East blows up, oh, surprise, surprise, and the oil prices go to $180, and there is a run of the bank to step in, the RBA would need to ask the Treasurer for more money during a crisis. It would be better to recapitalise the bank sooner rather than being in negative equity for so long. Someone said the government quickly restoring the central bank to positive capital would be a much better look. Extreme events, right? There hasn't been an extreme event in the last couple of years. Are we in an extreme event at the moment? Are there going to be more extreme events to come? I'll let you be the decider of that. Negative equity complicates extreme events. It does affect monetary policy because at the end of the government is standing behind the bank. Right now we're running surprisingly large budget surpluses, so why not inject that into the bank? A multi-billion-dollar capital injection would jeopardise Dr. Chalmers recording a second straight budget surplus. So it looks like that they've got a budget surplus over here, but what they've done is they've taken it from over here. So if you had two pockets and one pocket had a $50 note in, the other one had a $50 note in, and you go, well, I only want to touch the pocket over here, it doesn't matter which pocket you go into, it's which pocket do they want to take it out from. So we're seeing the government's reporting that they've got these profits and whatnot, but they're just profits based on borrowings they've taken from over here, and now we've got the RBA allegedly in the red. The RBA and the government insisted a recapitalisation is not necessary. The bank can operate monetary policy effectively. The government will not receive a customary circa $2 billion annual dividend for at least a decade as the RBA rebuilds its buffers. The RBA broadens approach to restore the capital position over time and has made it clear that it does not affect its operations for money. Sharp interest rate rises smashed the mark-to-market paper value of 330, interesting number there, billion of federal and state government bonds. The RBA bought in the pandemic to reduce the government borrowing cost and put downward pressure on the exchange rate. The RBA will also lose a total of about $8 billion in cash connected to pandemic-era $188 billion term funding facility, TFF, which gave commercial banks 3-year fixed interest rates at ultra-low rates as little as 0.1%. The central bank is now paying those same banks a higher floating rate of 4% on a $362 billion of excess reserves deposited in the RBA and losing money on the difference between the lending rate and the deposit rate. QE's hidden cost. Monist, an university economist and former RBA official, Zach Gross, said the losses were hidden cost of quantitative easing and the RBA could be forced commercial banks to repay some of the benefits they have received. Anyway, we'll go all the way through it. We're seeing these people complaining and whinging and saying, oh, my rent's too high, I'm doing it tough, whatever, but they're never saying that it's because of these things which have caused the robbery to everyone in this country. So what is my take on it? I'll come to that in a moment. Here we are, just with a random article here. September retail spending jumps ahead of Melbourne Cup rates call. With monthly retail spending rising the most since January, pressure is mounting on the RBA to hike rates when the board meets next week. I believe that we're stuck at a high level, right? Whether they increase it or don't increase it, we are on the eve of something imploding, and when that implodes, we're going to see a reversal in monetary policy. It has been 18 months since the first change in monetary policy from us being at a zero base cash rate, pushing it upwards. 18 months is what it's been going up. In that time, rents have gone up, inflation's gone up, everything's gone up. People's life may not be feeling so great, but a lot of people out there are hurting even worse than us poor investors, which can pass on our inflation and say, okay, tenants pay us more income so we can cover some of those costs. So my thoughts and my take on it all is just very simple to what I've always said throughout these last few years about this, is that whatever happens to the interest rates next week, there is a trajectory where they have to come down based on the amount of liquidity out there. Otherwise, we're going to see, a contagion of things starting to, like a fire where it spreads from here to here to here. If you have a box of matches and one of them gets a light, it doesn't take long. If you have one match of light, it's going to go bzzz. There's my interpretation of a burning match. And then you put that next to the other ones, the next one goes, and they all go. So we're waiting. It's coming closer and closer to that big pile of matches where it's like, and burning down. So, it's my thoughts on it. So I'm excited to see what they do. If they put interest rates up, it's going to put more pressure on the system, and it's going to help expedite that situation. So, what do we got here? I'll get into your questions and comments. Keep the comments coming. Keep the questions as we jump into how to build tips to build a multi-property portfolio. Hello. We got here. I make car filter like 20 plus. Everything is going up. Exactly, right? I have been ordering. I've probably spent about $200,000. Yeah, probably about $200,000 on skip bins in the last 12 months. Would have at least spent 200 grand, $250,000 on skip bins. Skip bins for my 13 cube hook have gone up from $1,350 just a year ago to about $1,700 or $1,650 or whatever it is at the moment. So when I look at that, I'm like, that's there's $300. That's like 20% increase just in one 6-month period. And I'm sure next year it'll go up again and again and again. They're things that aren't talked about in there. So when a builder's building a house for you, that's something to take in mind. When you look at the cost of concrete, right? A cube of concrete, I remember getting for like $80 back in the day. A cube of concrete is now like $300, $350 for a cube of concrete, which is a pallet of concrete basically. And these are all the things that are required to build our country, whether it be a road. So if they're building a road, you drive home tonight and you see that that someone's building a road, right? The government's building a road. Just know that when they're putting the path, the gutter, everything in there, that from 10, 15 years ago, that's 3 times the amount of price. When it goes up next time from $300 to $350, it's only $50. It doesn't really matter, right? But that $50 is nearly what it cost 10 years ago for the whole cube of concrete, right? The exponential rate that it's going up is runaway inflation. It's happening in front of us, right? It's happening in front of us in all walks of life. People are oblivious of it, and I think it's amazing. So, so just what are we looking at here? Love a good Ponzi scheme. Love a good Ponzi scheme. This is a Ponzi scheme we can all play in, right? Is the 50-year mortgage coming? That'll cause prices to rocket. People never pay their mortgage off. Like I see people all the time that are 60 and they've got $500,000 left in the mortgage or whatever the case may be. People refinance and they refinance at 50 years old and pull out $500,000, whatever the case may be. So imagine having no debt in a time like this. What a time to be alive. Exactly. Imagine owning no house in the roaring 20s and just looking at the market. Exactly. Now it's time to buy up. There's always an opportunity. There's always an opportunity. Lisa said, I just paid for $1,200 for a car service. Right? That's the Jeep. It's crazy. You know what's better than this? Watching this, sending invoices for watching this. Get those invoices paid as quick as you can. Buy more assets. Buy more things that are going to create you more cash flow. Tradies are $90 an hour. My God, look, they're getting up there. I remember paying people $150 an hour. Oh, yeah, I'll work for $150 a day. That's like $90 an hour. Look, it's important to find. When I get my trades, I look after it. Right, I've got very trades that love working for me. I pay them well. They're appreciative, but they don't. At the end of the day, understand inflation. So they're just, oh, boss, yeah, we'll do that. So it's important to find the value out there. So before I get on to the next step, Chris asked here, what is your thoughts on Bitcoin? I got into Bitcoin at $500 when I got into Bitcoin. I'm a big fan of Bitcoin. My mate, I need to call him on the way home. I've got a solar farm around mine crypto, and I'm very invested in the crypto. But once again, I feel like, just like everything else out there, it is a big Ponzi scheme. I used to spend a lot of time, effort, and energy into, oh, this thing's going to go up, this thing's going to do this thing's going to do that. But I realized that it's a bit of a big Ponzi scheme, just like everything else out there. But at the same time, there's opportunities that you could turn $100 into $50,000 type scenario. So I've had coins go up from $1 to $350, and that just means $1,000 turns into 350 grand. There's a lot of opportunities. You can't find another investment that would do that, but I've also had a lot of them go from $1,000 down to $20. So be very, very cautious. Everyone's out there an expert in crypto, but the reality is that no one can give you actual crystal ball on that front. So, and I'm not here to challenge and debate people, because it's like, this is the Lord and Savior, it's crypto, right? And I think that there's a lot of opportunity, and I think that if people realised what Bitcoin did and how it behaved and how they use it for peace and prosperity like never seen beforehand, we probably wouldn't have wars in different nations around the world. We wouldn't have controlling nations which create fear and pain and suffering on other people, and it would create peace and prosperity like never seen beforehand. But people don't know what that is with crypto, and they invest into it for trying to make a quick buck and all that sort of stuff. So it's interesting. It's a project that's out there, and it's I think people should have investment in there. I'm not advising to or against it, but I see people that have $2 million in crypto, they put 100 grand in, it turns $2 million, and then it turns back to 50 grand or 200 grand or 300 grand. Everyone's like, shit, I should have sold the $2 million to $3 million. It's yeah. I'm going to get into my main part of the conversation. Keep the questions coming. I've seen your question there about Airbnb. I'll get to it a little bit later. So talking about inflation, right? One thing that I've been doing recently across my portfolio, I've been obviously in Queensland for a couple of months, and I've been in back home doing all my renos and stuff. I've realised something really, really big at the moment, and there's times where I've been very big on accumulating assets. There's been big times when I've been, not so big on accumulating assets. There's times where I've been renovating assets, and I see at the moment, properties have gone up in a lot of areas. They're going up to all new highs, and I've got a lot of them. So I see that the gap is closing, right? Whether it be the concrete that used to be $90, which is now $300, whether it be the bin that used to be $1,300, which is now $1,650. And those bins used to be like, I remember getting bins from this place called Metro Skips in Sydney, and I was paying $80 for them. There was a $95 price with a $15 coupon or something for the paper. $80 for a bin, and now that same bin would be $600-700. So I'm seeing the cost of everything running away. I'm looking at my assets that I own currently, and I'm seeing, okay, if I can get a trade while it's cheap, I could just renovate a property. So I have one that I took some videos of. I put it on my Instagram page. So I put a random shit on my looking at a property I've just started renovating. It needed new gutters. The bathrooms were a bit shit, and I thought to myself, I've got to get the tiler out to tile the bathroom. I've got to get the guys out to paint it. The place is going to be vacant for a while, so let's just do a full reno. So whilst I'm there, I've got the tiler to do the 2 bathrooms, and I'm sitting there thinking, okay, the tiler's there doing the bathroom. I can get someone in to carpet it or leave the carpet as it is. But if I have the tiler there, and I can get the tiler to tile the tiles at a certain price, and I can get the bathrooms at a certain price, it's only a little bit extra. I've still got the same bin that can be used to throw excess rubble in the shed. I've still got the vacancy factor whilst they're there. It might take an extra 2 or 3 days. Just do the reno whilst it's cheap, because I don't believe that I'll be getting trades at the same price as what I am today. There's people here saying that trades costing them $90 an hour. Part of me is like, I'll never pay $90 an hour, but another part of it is that I will be paying that in the future, and I'd rather take those things and add them to my assets now and improve my value, because If I can spend if I can spend 15 grand on a reno, and I can add $150 a week in cash flow from it, that's a 50% return on investment. There's not many assets which will give you income in perpetuity of 50% yield year in, year out, plus the value of the capital of the asset would go up by a greater level of those sort of figures. So I've been going out doing some of those renos out there. I've personally aren't doing anything to them. I might be reading a trade here and there, do this, do that, send them what they need. I got a text from one of my trades this morning needing 6 bags of GP and a half ton of Sydney sand. So I caught up, ordered that, it was there an hour later. I manage projects, but I'm not physically hands-on. And I ended up looking at a reno that I got sad on it the other day because I was like, I put that kitchen in 20 years ago, right? And I look at the kitchen and I'm like, it looks shit now. But at the time, it was a second-hand kitchen. I put $150 worth of 2 kitchens, so I took all the cupboards off them, put the kitchens, and they're like 10 years old from a demo sale. They looked still brand new. And I needed to put a new bench top on, so it was like $60 for a length of bench top, and I cut up and put it in place. And the place was serviceable, but I'm like, whilst I've got the tiler in there, I'm spending extra 2 grand now. I'll get a little kitchen put together, chuck it in there. That's going to add a lot more value. So it's something that you should be looking at every part of your life. I have quite often people saying, I see you growing your veggies, I see you growing your food on your social media and stuff like that. That's cool. I think people should be, looking at all the areas of their life and thinking this ain't a time that you should, what happens if your bag of fruit and vegetables go up? We've seen lettuces at $15 or $10 in the lettuce crisis, right? We had a flood and lettuces went to $15. It's like, what happens if that becomes the norm? And that's where inflation has taken all of our food to. And what can you do to try and protect yourself before we get there? So apparently I'm making everyone's thirsty from the talking of food. I think there's a little side chat going on here. So yeah, looking at tonight's discussion, how to build a multi-digit property portfolio. Can you still build a large property portfolio in 2023? Yes, you can. The opportunity is still out there to be able to build portfolios of that size. What are some of the things that will help you get ahead and be able to capitalize on that? So I'm seeing so many people at the moment which are coming back with equity from, and I actually said to my team recently, any of my clients that have bought properties for, like those of you that might have been new around here watching, I run a buyer's agency. I was probably one of the first buyer's agency in the country. I buy properties that are below market value for my investors and build their portfolios. And any of my investors that I've bought for any time up until like a year ago, their properties have gone up in value. As the interest rates are rising, their properties have gone up in value. So I'm like, let's go and revalue our investors' portfolios. We can rip out some equity for them. They can go on and do more things. So I'm looking at a lot of these portfolios and I'm seeing people that are getting still 8 properties in a year, 6 properties in a year. And if someone's getting, everybody's position is different. I'd say on average, people would get like 3 to 5 properties a year throughout their portfolio. Some might only get 1 a year, some might get 15 a year, some might get 20, highest has like 30 plus. But, is it still possible to do that? Yes, in short. It is getting harder and harder to do that because you're finding it harder and less options to buy properties, for example, under $200,000, where there's $200,000 is a sweet spot where you can get your equity back out very quickly, where you can keep the banks happy, and where you've got ample cash flow. Because if you go up to a 500 grand level, the rent hasn't matched that, and that's going to throw your portfolio off and not allow you to be able to service the banks to continue that portfolio on. So I guess probably the first thing that I would recommend to anybody is to make sure that you have clear goals. If you're looking at your property investment portfolio like a business, I always say treat your property portfolio like a business, that we should be knowing our numbers, knowing what numbers should look like, how they'll stack up, and having a business plan around that. So what is your business plan? What is your strategy around accumulation of assets? What is your strategy around getting the debt and obtaining the finance to get those properties? What is your strategy around paying them off? What is the strategy of multiplying and copying and pasting that portfolio? And I think the reason why so many people only have 1, 2, maybe 3 if they're really lucky, and not 10, 20, 30 is that they haven't focused in, honed in, and actually designed that strategy to be able to copy and paste it at such a rapid rate because they don't have a sound plan. So make sure you've got a plan. If you need help on building that strategy, there's a link in the description here somewhere, up, down, sideways, wherever you're watching this from. And you can contact the office on admin@binvested.com.au, have a chat with someone about what, it's a free chat for a discovery session with my team to see what options there are to be able to push yourself to the next level. I'm going to get some water. I think I'm getting sick, maybe. I was out walking without a shirt on at 2 a.m. on the phone this morning, so yeah, maybe it's got something to do with that. I guess, whilst you're planning, whilst you're building a strategy, a lot of people don't sit there, and people are spending more time planning for what they're going to do at the Christmas holidays, on their, there's Thursday tomorrow, or Wednesday tomorrow, whatever it is. People getting paid this week. What are they going to spend their money on Thursday night? It's not by chance. They've got Thursday night, late night shopping. You get paid on a Thursday. Oh, let's go out and spend that money. People spend more time planning for that sort of stuff than what they do for how they're going to exit the system and how they're going to be able to, spend the next 40 years of their life. So, working out what that foundation looks like and how you can build from it. What are the opportunities that you've got in the position, and how can you keep maximising and expanding the opportunities? So, looking at that. And I guess from an acquisition perspective, you need to work out, what are those properties going to look like. And people kind of get caught up on, sorry, I just had a little stutter there, and I was like, you. People get caught up on the fact of, okay, a house is what's going to be important. This location is what's important. Units are no good. And they're caught up on the little things. It's like, no, you just need more, right? If you had $1 million worth of house or $5 million worth of unit, if the units double in value, well, then your $5 million turns to 10. If your house is double, you've got $1 million that turns to $2 million. So you need to work out what is it going to look like, not just today, but when you're 5 steps down the road as well. So, and what should that portfolio look like? I've spoken to, I reckon how many people have I spoken to? I would have spoken to at least 20,000 people in the last decade, one-on-one with investors. That's what we do here. Working out, their positions. And when I see people's positions, they're like, how bad is it? What can I do? Where am I at? Were the properties bad that I bought? And I see so many people that have bought good properties or decent properties, but they've bought them at the wrong time, which has then capped their financing because they didn't have a finance strategy. They didn't know how debt worked. They didn't know that, they didn't have financial literacy. I was listening to this chick on YouTube. She's a business chick. She talks about buying laundry mats and stuff, right? Her name's Cody Sanchez, and she said, it sounds really funny name when I say all that, but she does these business little reels, and she was talking about when she worked in a brokerage firm, that people don't understand the words of money, right? They don't understand the financial literacy. And I'm not talking about balance sheets and stuff like that. I'm talking about, it's easy for these people that are on TV, right? We're all the news, all these people that are, all the experts out there, right? And they're talking these big words and whatever. If you don't understand those words, you need to go back and spend the time understanding how all those things work. Because once you've got an understanding of how the system works, then you can go back and perform it, be the best that you can in there to take advantage of it. So looking at your personal position, once you've got a plan, once you've got a strategy, once you know where you're at, and you can pull the trigger, where we're buying the properties, what are the properties going to look like. There's people out there saying you should buy in a blue chip area, and I was talking to someone the other day about I bought these units in Vaucluse going back like a decade ago, and my thoughts would be that they should be paid like 500,000, 550 for them. They're worth 1.5 mil today. I'm like, these things should be worth 2 million, right? But when I take that 500 grand that turns to 1.5 million, that'd be like taking 150 grand property in Mount Druitt if that worked on the same numbers, it should be worth 450 grand out of Mount Druitt. But try to find me a house at Mount Druitt for 450 grand, they're all up at $700,000. So it's actually double performed from a western suburbs location to a eastern suburbs location, which is the best or most expensive suburb in Sydney, and the most amount of billionaires and all that sort of stuff. So, you know, what is it that your portfolio needs? What is it that it requires? And are you putting the right things in your portfolio at the right time? And I think that the biggest thing that gets people stuck is they haven't got that strategy, which means that they're out there buying the wrong assets at the wrong time, or they could be the right asset but just at the wrong time, and getting themselves stuck. So every time I do a deal or make a decision on something that I'm doing, I'm thinking about, if I move this chess piece forward, how's it going to protect me? How's it going to get me more options? Most people just go, okay, I'll just move the chess piece, right? Next minute, gobble, 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 right, gone. So what's the risk of you making a move, whether it's buying a property or not buying a property, whether it's refinancing or not refinancing? You need to get good at ascertaining that risk, but you don't know what those risks are if you haven't taken the time to understand the game board that you were playing on, which is why I guess I talk so much about macroeconomics and looking at all the finances work, because the properties, at the end of the day, if I sit here and say I've got hundreds of properties and you know, all these different things that I do, then they're only worth what they are. At the end of the day, the year 2000, if I've got 200 properties and I've got 200 properties in 2030, the properties could be worth $50 million in the year 2000, and in the year 2030 they could be worth $1 billion. But what made them different didn't mean anything. Their houses still exist, but all that happened is the money, i.e. the currency that they're traded in, has lost all of its value. And if you don't have a good grasp on that, then how do you know how to play in that game? So very, very important. I think with debt, making sure that you've got the right finance structure in place, making sure that you've got the right finance team in place, making sure that finance is going to support your goals. You want to make sure that those actions that you are taking are going to get you, people, for example, would be looking at finance and thinking, what is the best interest rate that I can get? And it might be the difference between, I don't know, 5.99 and 6.05, right? Or 6.2. While most people are focusing on how can I save $1 over here, I want to think to myself, how the fuck can I get the equity out within a month? How can I get the equity out in the next 3 months? If that bank won't allow me, or the product won't allow me, or it'll trap me into the deal, or the mortgage insurance won't allow that to happen, well, then it's probably not a good thing to do. I need to look at other options of what's the next move after that. Once you can make a deal happen, that deal is baked in the cake. You can do it. So when I talk to my investors and any of you guys that I help out, yes, Lisa, I just saw that. I laughed there. Lisa just said here, I hope you didn't get blown away. I thought we were in Acapulco at 2 this morning. That's a very bad analogy of people that go in Mexico. But yeah, it was pretty wild out there today. I've got a mind blank of where I was up to before I saw that. My mind just got blown. So, what was I saying? I know I was talking about, maybe someone could give me a little prompt here, but when you're looking at finance, yeah, that's what I was talking about. It was finance. People aren't looking at the right things, right? You need to be. If you guys hop on the call to me, I'm on the phone, we're having a chat about your position. Someone's like, okay, I can buy 3 properties today. I've got 150 grand as deposit, or I've got 50 grand as deposit. I'm not thinking about the property we can buy today or the 3 properties that we can buy today. I'm thinking about, if we buy those 3 properties, how do we get to the next 3? So we've got 3, we can do them. But once you've got those 3, are they going to gridlock you from doing the next 3, or are they going to help you step up on top of them and take it to the next 3? So I think it's important to understand how the deals work, and not being emotionally invested and looking at the long-term vision of the portfolio, how it's going to perform. The feeling that I had going out yesterday with my mate, he was excited because he's seen half a dozen of my properties. I was driving through a little patch with a few of them, He's like, fuck, I wish I could have some of these properties in my portfolio, like you've done really well, all this sort of stuff. And I'm like, yeah, I don't even see them as that anymore. It's like those things have helped me get into. He goes, what do you? I want to. And I'm like, oh, they're worth a mil, owed 400. It's like shit. I'm like, but I bought it for 200, right? And I had to refinance out. But when I pulled that equity, what did I pull that equity for? I could have pulled the equity to buy my first motel back in 2013. I could have pulled equity to buy my first shopping centre in 2010 or whatever it was. And, it's those sort of things. If I didn't make that step on certain deals 10, 15 years ago, it wouldn't have enabled me to do certain things that I do today. But thank you, Lucas, about reminding me about the interest rates and that. People just focus. They don't. I think people get caught up in small menial stuff, but it's the strategy. It's the overall strategy. That's the biggest way to get ahead. I can sit here all day and say, yep, go and buy a property that's like 100 grand property, go buy a 200 grand property, here's the best property, here's 5 properties. Rarely when I'm talking to people am I talking about, hey, this is a good property, go buy it. It's like, this is a strategy that you need, this is what we need to do to be able to leapfrog and get to where you want to be. Hey, this property here can help you buy X, Y, Z, 1, 2, 3. And those properties, do you need cash flow in your portfolio? What is the bank requiring from you to get to the next stage? Do you need more deposit? Do you need more equity? Do you need more cash flow? Do you need more savings? And they're the questions that you should be asking you. What do I need on my next stage of my journey to get me to where I want to be? You could be at property number 1, working out how to get to number 2. If you're at property number 1, going to get to number 2, you need to think, okay, what is this bringing to the table? You could be on 250 grand a year income, have no savings, and people out there are in all different weird positions, and then be like, okay, I'm going to buy a property that's going to give me $20 per week income. You don't need $20 per week positive cash flow. You need to worry about your deposit for the next property. You could have someone that's at a later stage in life where they've got good capital, but they don't have the cash flow coming through, or they're transitioning into retirement. And it's like, well, their focus shouldn't be so much on the equity perspective. They might be more inclined to be taking the cash flow. And it's like at different stages of your journey, you're going to need a different vehicle to get you to the next level. And it is getting very, very tight out there with just in general in the market. Prices are rising to all new highs. The cash flows are great because the rents are going up. If I take Gold Coast for example, we used to buy about 50 properties a month for our investors in the Gold Coast. I did that for maybe about 7 years. I was buying so much there. I buy a few up in the southeast Queensland corridor now, but it's a bit different. I buy lots of different locations. And, most people will be out there going, we should buy in the Gold Coast now. The Gold Coast was $200,000, now it's $600,000. It's a booming location. Reality is that when you bought in at 200 grand, getting $300 a week, it wasn't sexy. But now the rent's gone to $600. It's very sexy, right? It's giving you $300 a week positive cash flow. If you've got 10 of them, you should be able to retire. Woohoo! Lots of investors were able to do that over the last couple of years. But buying it at 600 grand, getting $600 a week, that is a very, very bad investment because the numbers just do not stack up and they're going to gridlock you and wreck your financing acquisition ability. So it's factoring in the overall strategy, which I don't think many people do that well. And when you get to the property strategy, thinking about how the property is going to help you acquire more and build more wealth. And I guess when you look at the later stage of the portfolio, how these things are going to get you through retirement. So I've sold properties over the years. I'm not that happy about the properties that I sold. I've never had clients call me up and say, hey, Birchie, I'm so happy. In 2010, you bought me a property for 150 grand. I sold it for 250 grand, made 100 grand, made 70% profit in a year, right? And 250 grand, so great. Thank you very much. They might say that on the day. But when you go back and ask that person, oh, what do you think about selling that property? They don't fucking talk to me. I should have bought more. I should never have sold. Things worth $1 million now, etc., etc., etc. So it's looking at what is your strategy. You're going to hold for 10 years, 15 years, 20 years, and you're going to use that property to leverage yourself into blocks of units, etc. A lot of people say to me, I just want to buy a block of units. It's like, if you're going to go out and buy a block of units, right, just as an example here, if you had, let's say 200 grand, and you could borrow 500 grand worth of loans, right, you'd have the purchasing ability to do 700,000. For 700,000, you could buy a house somewhere, or you could buy, there's locations in the country where you could buy a house for 500 grand, or I could buy a block of 4 units that are worth 250 grand a piece for 700 grand, right? I'd rather take the 700 grand for the 4 units. But people come to me and say the 4 units are the best things to buy because it's all on one title, there's no strata, whatever. There's a problem there, right? And the problem is that when you go and buy a block of units, you're going to have to put down a 30% or a 40% deposit because the bank sees it as commercial by nature and they're going to want you to put more skin in the game. So instead of you being able to buy $1 million worth of property with your 200 grand deposit, 20% deposit, buy $1 million worth of asset, you're only able to go and buy a $500,000 property with a 200 grand deposit, 300 grand worth of loan. So your total exposure to the market isn't as great because you can't leverage your LVR to the greatest level that you can. But then let's assume that you accumulate that asset. How do you go on to buy the next property, right? And we go back to the bank and get a revaluation. Well, the bank looks at your block of units and they can't pull the same equity out that they could from a house or a unit or a townhouse or a villa. So I'll look at a little unit, for example, that you could pick up for 150 grand, 200 grand. You might be paying a strata levy on it. However, you've got multiple other properties. You've got the ability to access finance better. Your cash flow is probably better than owning the block of units because you're responsible for your insurance and all that. When you're buying a unit, it's aggregated down to a smaller level and the strength comes in numbers of buying insurance on a cheaper policy, etc. So there's other variables that are there and your numbers stack up better. So it might be that you buy 5 units, 2 houses, and then, I don't know, 3 villas, and then you've got 10 properties there, and in those properties, you go back, rip out equity, and then go buy yourself a block of units. It's the sequence of what you need to keep the bank happy, but also minimize your own personal risk. Because if you just had one property which had a whole block of units, and something happened to you, you needed to get liquidity in or whatever, you can't just go and sell one unit off, you've got to sell the whole block. You could just sell off one little unit over here, pretty risk-free. See you later, still got another half dozen here, move on with my life. If you had to sell and it was all attached, well then your liquidity has dried up and you're going to be like one of those zombie companies that we're talking about in the news beforehand. So looking at the strategy of asset accumulation, very important. Looking at the strategy in general, very important. Your finance is the most crucial part. If you don't have the finance right, people are focusing on, I want to save interest rate of 0.25%, or I want to, get positive cash flow $20. It's like, that may not be the right thing for you, right? It is what it is. If someone said to me, hey Nathan, I'll give you interest rate at 5%, I'd be, whoo, right? Yeah, I'll give you an interest rate at 10%. I'd be happy. If the terms of the 10% are great, I'd rather take the 10% interest rate than I would the 5% interest rate. It's all about the terms and the overall facility of that debt and how it's going to help you in the longer term. So, and I guess one of the big things about being able to build a large portfolio in a quick time, especially in the current market that we're in, because things are changing. It's going to get some more water. Being fluid, not drinking water like I just did, right? But being fluid to change with markets, right? If I was sitting here thinking houses in Mount Druitt that I used to pick up for 150 grand, I can't get them anymore, I'm not going to buy anything, then I'm going to be sitting here waiting for something that's not going to happen. I have to change my game. I went and bought on the Central Coast. I bought heaps of shit on the Central Coast. So actually, everyone knows me from being the guy from Western Sydney that bought houses in Mount Druitt, the guy that, the Donald Trump at Mount Druitt. But I actually thought about it the other day, and I've bought many more on the Central Coast in New South Wales. And then I went into Gold Coast and Cairns and different sort of markets that are out there, and I've bought right at the bottom of the market. I've bought because of what I've needed to get myself to the next stage of the journey. I didn't sit there and go, well, the market's shifted, it's all game over, because there's lots of different things that you could be doing, and it's just finding the best thing on the day. People ask me, what is the best buying in Sydney? I've bought heaps of houses in Sydney. I've bought heaps of units. I've bought heaps of acreage. there's only a few markets in Sydney, for example, which you can buy properties for 300 grand still. Those markets, if you can buy a property in Sydney, and you can, they used to sell for 400 and you can pick it up for 300 today, right? I want to say 400, that was 8 years ago, and you can pick up the property for 300 today. You can get them out there, so just throwing it out there. There's only a few markets that will allow for that to happen. I reckon 90% of the market I wouldn't touch, and there's a few markets which are at the top end, which are $5 million assets that I would touch. There's lots of stuff in the middle where it's like the risk is too caked in. I might go to another area and I'm like, hang on a second, I'll only buy the houses in that market. I don't want to touch a unit over there. And it's knowing where the value is and being able to shift with markets, right? And being fluid with being able to change your strategy. The strategy should remain the same. 20 years on, I bought my first property 20 years ago now, and the same strategy that I had back then, I just had to go to different markets. I had to change things, and people don't keep up the times. You look at companies that have gone bust in years gone by, Kodak, Blockbuster, whatever they are, the market overtakes them. So how can you keep being fluid in your property investment business by growing, expanding, and moving and changing and being the person you need to be for the next chapter that you're walking into on your journey? So on that note, I'm going to look at a few of your questions. I'll answer them. If you've got any questions, shoot them through. Forever hold your peace. Ask me away in the comment section, and I'll try not to spend 2 hours on a Facebook Live today. So what have we got here? Questions. Got some communications going on. Andrew and Pat, hi, everyone's doing well. Jonathan, talking about zombie companies, there's like 30 of them at my door asking me for candy. Good luck everyone out there. So lucky I live on a farm and I don't get those sort of nuisance knocks on the door. But yeah, here we go. Sam's good question. Is it possible rates won't come down and that is the hyperinflation endgame now? Look, anything is possible. I don't think we've seen the hyperinflation. If we go back and look at any other currency that's out there or any other country that has gone through a hyperinflation, it's very important, right? I said beforehand about that Cody chick that did the video that I was watching and talking about, she said the financial wording, right? The language, the financial language. They don't teach you. She was talking about EBITDA and different things around business, right? But there's the whole financial system. They don't talk about quantitative easing. They don't talk about hyperinflation. They don't talk about this. Once you understand these terms, you can just start seeing it's like that doesn't add up, right? It's it doesn't add up financially. So you need to look through all that. And my view is looking at all the countries that have lost their currency, which is fantastic when it does. 95% of people get wiped out. So apologies in advance. And on the day that it happens, always say, because they're going to be, oh, Nathan, are you going to go and celebrate your success today? If something good happens, no, I just need to get back to it, right? It's just moving forward, right? If there'll be times where people would do it tough. We're all doing it tough, right? I do it tough, you do it tough, different levels of tough. But as we navigate through this ocean of changes that are constantly coming to us from the day that we were born, we've got to navigate ourselves through those rough seas and whatnot. So here's my disclaimer, right? People will get injured from a hyperinflation. I believe that I've put myself right to capitalize upon that. And I think most people won't, right? And if we look at life, most people haven't done lots of things, and they controlled from the media, obey without questioning, follow with blind faith, and don't ask questions. So I'm excited that everyone asks questions around here. But answering the question of hyperinflation, if we look at Turkey, we look at Venezuela, we look at Zimbabwe, we look at Hungary with Tango, we look at Germany, any country that's lost its currency will happen. It's happening to us right now, but we don't realize that we've lost our currency. We still think we have it, but we don't have it. And it's evident from the financial markets around the world. So, looking at it, I don't believe we've got to the final blow-off top stage of that. and I believe it will happen this decade, but we're on the eve of that happening. Um, so yeah, there will be a point, if we look at Turkey, their interest rates, they went through a hyperinflation, they still are, if you look at Lebanon, right? Um, their interest rates went up to like 80% or 100%. Who cares if the interest rate's at 100%, right? Just put it out there. Here's a good question, right? You might get me on a roll here, right? You might get me on a roll. Who cares? I will pay 100% interest rates, right? 100%, and be fucking happy and thankful for paying 100% interest rates. I wouldn't be paying the interest rates now, and I wouldn't see it being a feasible thing. Feasible. If the inflation went up at 500% for the year, so a paddle pop that was $2 goes to $10, right? You have 10 years worth of inflation just in 1 year. That's not a hyperinflation. A hyperinflation where it doubles every day for like the next month, and it's it's $1 million for the lollipop or whatever, right? I'm happy to pay at that point, right? Because the cash is so worthless, right? It will be just destroyed. It's like, I wouldn't even want to pay that off. I'll just be happy going, here's your 100% interest. Good luck to you, right? Your money, you're never getting your money back. They're never getting their money back because the money is worthless when you pay it back. The money is worthless. It's lost all its value. So do I care that interest rates go to 100%? I'm fucking happy to pay 100% interest, right? You've heard me say, here's a news headline for everyone. Crazy guy, right? Birchie is happy to pay 100% interest. I'm happy to pay that if we've gone through a hyperinflation and inflation's at 1,000% per annum, because I'm paying them back scraps. It's nothing. I'll pay your house off with the last little drop of water in the cup. Here's your box of swaddling tissues or whatever, right? Here's one tissue, right? There's your mortgage paid off. It's literally what they've done over the last hundreds of years, thousands of years, right? But it's ramping up more and more than ever seen before. I've got one last question I'm going to answer here from Maddie. It says, how far away is digital currency, do you reckon? They've taken the on-ramps off. They're taking the on-ramps off. It's getting closer and closer by the day, the week, the month. We're losing. There's less ATMs out there. They've halved the ATMs in 5 years, right? So 5 years ago, there was double the amount of ATMs that there is now. So in a year's time, will there be half the amount of ATMs? It's the reverse of inflation, right? They're just removing all the access points. They're closing down your bank branches more than you can, right? I've got cards in my wallet here, right? Without giving away too many details, there's like a pink one and a grey one there in the background, right? There we go. So out of my two cards, one of them got hacked. The pink one got hacked the other day, right? So I got a new card. I went to activate the thing, right? When to activate it, the app won't allow me to activate. I've got to go into a bank branch to activate it, so I can't activate the card. Then this other card, it's like a credit card I had for years. I never use it. I just pulled it out. I don't have a PIN number. So I went online and tried to set up a PIN number. Who wouldn't let me set up a PIN number? They go, you have to go to the bank and verify yourself. So I have to go through and fucking tappity tap to get $100. Lucky I don't spend much on anything, right? When I use it, I just go, oh yeah, here's the digits of it, and I give it over the phone. That's probably how my old card got hacked. But, accessing cash, you go to the bank and say, hey, give me 20 grand. You're going to be asked a million questions. You're going to have a report sent to AFCA about why you pulled out cash, why you deposited cash. Very, very, craziness that happens out there. So we're heading to a digital currency, but no one's realised. Everyone's waiting for, when's the digital currency going to come? We've got the digital currency. There we go. Mine got hacked too, so did my friend. It's happening a lot lately. I couldn't pay for anything. Sorry that happened. I think they just refunded it all to you. But yeah, I just see it. It's constant. Like it's a very common thing to happen out there. So I guess if we have a digital identity, and a digital wallet that's verified by the government, which would be safer. I actually think they could blow up the crypto market at one point and go, well, that's because that's unsafe. We've got a safer version of Bitcoin, we've got a safer version of crypto. Here, take the Gov coin, take the Aussie dollar coin, whatever it is, and try and just, it's a safe one. You should take it. It's safe and effective, right? But yeah, that's my thoughts on that, my 2 cents. So on that note, folks, I've got to go and do some emails, catch up on, make a few phone calls, and get on with some other stuff. So I'll let you guys get back to the evening. Thanks a lot for tuning in, listening. If you like tonight's video, give us a like, share it with friends and family. I think sometimes the things that I say out there get me shadow banned a bit, and I don't get as many views as what I should get, and as many likes. So make sure you smash up the likes, tag your friends and family. If there's something you want us to cover off on, send us a DM, and we'll cover it on one of our next episodes. I'll be getting back to the No BS Virtue podcast very shortly for everyone, and we'll catch up soon. If you need help, you can always reach out to us, 1300 367 925, admin at B.Invested.au, and there's a description with a link to get in for a discovery session with my team to see a bit of an experience of where you're at, what you can do, float some ideas past the team, and see how we can help you with your journey to kick ass, to live life on your terms, and get through the apocalypse that's out there. So catch up soon, folks. Have a good one. Bye for now.